Everybody, hope you had a great month of March. We're now into April, and this is the Rate Watch report for the month of April. We're just going to take a look back at what happened, talk about the three things that we want to be paying attention to as the economy shifts and changes, and we'll head to the slides right now. So hey team, it's now April of 2024, and here are the three things that we're going to cover about rates in this month. So let's go over the basics again. So thing number one, bonds. If you've watched this type of video from me before, you know that up is good for rates and down is bad. So green is good or up is good, and red is bad, down is bad. And if we take a look at this month, I went back a full year to take a look at the bigger picture trend. So this is looking back a little bit further than what I normally do. As you can see in the last quarter or so, it's been a bit of a wild ride. We've seen rates go up, we've seen them come down and then go up and down. So they've been sawtoothing in a general direction over the last 6 to 12 months. Downward, but we're still not quite to where we would hope to have been if we're trying to get to some lower mortgage rates. So what's happening? Well, we're back to inflation again. So inflation is still being persistently not high, but it's coming down, as you can see by this chart, but it's not to where the Fed is hoping to be, and I'll go over that in the dual mandate section as an added bonus for, if you want to call it thing number 4. So inflation is coming down, and that's what we need to see happen in order to get lower interest rates. Additionally, we're taking a look at thing number 3, which is jobs. And this is not to say that we are hoping people become unemployed. That's not what we're hoping for. We are hoping for a right-sized level of unemployment rate, which is heading towards the right direction. And the trick here for the Fed is to manage the tools that they have to bring down inflation without tanking the economy. And as we're looking at this Fed dual mandate, where they want to see the maximum employment be at about 5%, we are below that currently, as you could tell by the previous slide. And they're wanting stable prices and moderate long-term interest rates as well. So that means inflation equals 2% to them. So we are still working on that, and without boring you to tears, the end result is we'll probably see Fed funds rate remain the same. We'll be watching inflation coming down, and hopefully not too many people lose their jobs, and we get right sized so that the economy keeps chugging along but not tank. So that's it for this month. I hope you have a great one, and look forward to talking with you soon. If you do have any questions about rates, about mortgages, about buying additional properties this year, feel free to reach out. I'm happy to help. Take care.